guys! Let's talk about something that literally keeps the economy alive, the financial system. Here are the 10 quick facts that you need to know. Let's go! Fact number 1. The financial system is like the economy's bloodstream. It moves money when it's needed the most. And speaking of money movement, for fact number 2, it connects savers and borrowers, people with extra cash and those who need it for business or spending. Now, here's what makes it all work for fact number 3. It made up of financial institution, markets, and instruments, the three main parts that keeps the money flowing. Let's break that down. Fact number 4. Financial institutions like banks and insurance companies act as middlemen, transferring funds and managing risk. Next up, where the action happens. For fact number 5. Financial markets are where people buy and sell assets like stock, bonds, and currencies. But wait, we also need the right tools for fact number 6. Financial instruments are those tools, checks, loans, and securities that represent value. Now, here's what the system actually does. For fact number 7, it immobilizes savings, gathers idle money, and puts it to work through investment. And it doesn't stop there. It facilitates payments. Every tap, swipe, or online transfer is powered by the financial system. Pretty cool, right? But there's more. For fact number 9, it spread and management risk through insurance, diversification, and financial contracts that protect us. For fact number 10, the financial system supports economic growth, helping businesses expand, jobs grow, and the economic thrive. And that's it for the 10 quick facts about the financial system, the real engine behind every thriving economy. Save this for you for your next study session and share it with your classmates.
Hey guys, welcome to my video, and today we're diving into Chapter 5 Financial System Part 2. First, let's talk about adverse selection. Adverse selection happens before lending, and it's hard for lenders to know who's a safe borrower and who's risky. Young borrowers with bad credits try to look good, and some lenders can always tell the difference. Fact 2. Moral hazard. This one happens after the loan is given. The problem here is when the borrowers might not use the money properly or hide it what they're doing with it. So basically, even after getting the loan, there's still the risk for the lenders. Fact 3. Did you know that both of these problems happens because of asymmetric information? That's when one side, usually the borrowers, knows more than the lenders. So yeah, the information isn't balanced. But good thing the financial intermediaries exist to fix them. Fact 4. Banks and other financial intermediaries help reduce the issues by collecting and sharing borrower information. They make the lending safer and smarter. Think of them like a matchmaker, connecting savers and borrowers but making sure that both sides are being pleased. Fact 5. One big solution is disclosure requirements. The second, other authorities require companies to report their financial performance accurately, like their assets, profits, and debts, so the investors can make a smarter choices. More transparency, less risk. Fact 6. To stop moral hazard, financial intermediaries also monitor borrowers closely. They check if the money is being used for the right purpose, kind of like your teacher checking if you actually did your group project. Fact 7. Another method, restrictive covenants. These are rules that limit how borrowers can use their funds. For example, they can spend the loan on random stuff. So it's basically saying that use it wisely or else. Fact 8. Now let's talk about transaction costs. These are the expenses involved in buying or selling financial assets, like broker fees or time spent on paperwork. Too high transaction costs can make the borrower or borrowing more expensive. Fact 9. But financial intermediaries can reduce those costs using economic scale. The more transactions they handle, the cheaper each ones become. It's like buying in bulk, but for finance. Fact 10. And finally, technology makes everything faster and easier. Banks now use ATMs, apps, and even AIs to check creditworthiness quickly, saving time and money for everyone. So now that's all for Chapter 5 Financial System Part 2. And let's proceed to Chapter 6 The Philippine Financial System.
Hi everyone, I am Alexa Novak-Lau and today we're going to talk about the Philippine financial system, what it is, how it's structured, and why it plays such an important role in our economy. So sit back and let's go through 10 interesting facts you should know. Fact 1. What is the financial system? The financial system is a network that connects people or organizations who have extra money with those who need funds. It helps move money efficiently through banks, financial markets, and other financial institutions, keeping the economy running smoothly. Fact number 2. Why is it important? A well-functioning financial system is essential for a country's economic health. When it collapses, like what happens in some countries such as Russia and parts of Southeast Asia in the past, it can lead to serious economic hardship. Fact number 3. The role of the Bangko Sentral ng Pilipinas, or what we call BSE. At the center of our financial system is the Bangko Sentral ng Pilipinas, or BSP. It serves as the country's central bank, regulating economy supply, interest rates, and the entire banking system to ensure financial stability and economic growth. Fact number 4. The Philippine financial system has three main parts: the Bangko Sentral ng Pilipinas, banking institutions, and non-banking financial institutions. Each one helps handle, protect, and grow money in different ways. Fact number 5. Private banks are owned by individuals or companies. Examples include universal banks like BDO or Metrobank. They do almost everything from loans to investments. Second is commercial banks that mostly handle deposits and business loans. And last is thrift and rural banks that serve smaller businesses and local communities. Each plays a unique role in handling funds and supporting economic activity. Fact number 6. Government banking institutions. The government also owns banks that serve special purposes. The Development Bank of the Philippines, or DBP, supports big development projects. The Land Bank of the Philippines, or LBP, focuses on helping farmers and the agriculture sector. And the last one is the Philippine Al-Amanah Islamic Investment Bank, provides banking that follows Islamic financial principles. Fact number 7. Non-bank financial institutions. Not all financial services comes from banks. Non-bank institutions includes things like pawn shops, insurance companies, investment houses, and lending firms. They offer other ways to borrow, save, and invest money. Fact number 8. Government non-bank institutions. The government also has its own non-bank agencies that support Filipinos financially. GSIS provides social insurance for government workers. SSS gives financial protection for private employees, and Pag-ibig Fund helps Filipinos save for housing and provides affordable home loans. Fact number 9. How these institutions work together. All these institutions, banks, non-banks, and government agencies work together to keep money circulating and to help people and business grow. Without teamwork, the economy wouldn't function well. Fact number 10. Why it matters to us. The financial system affects all of us, from saving our allowances, getting a loan, to investing in the future. A strong and stable system means more opportunities for businesses and individuals alike, helping our economy grow. And that's it. Those are the 10 facts about the Philippine financial system. It may sound complicated, but it's really just about how money moves, grows, and supports everyone, from individuals to the whole country.
Did you ever wonder where your money goes after deposited in a bank?
or how businesses get loans to grow, that's all part of Philippine financial system. Here are 10 facts. First, NBFIs are not banks, but they offer financial services. Second, example of NBFIs includes insurance companies, cooperative, pawn shops, and lending firms. Third, they support financial inclusions. Fourth, NBFIs help circulate money in the economy. Fifth, the Philippine financial system is evolving, and NBFIs are part of that change. Sixth, digital technologies is boosting NBFIs growth. 7. NBFIs are key players in rural areas. 8. The government supports NBFIs through regulations and policies. 9. There's increasing investors' confidence in NBFIs. 10th, the future of Philippine finance is diverse, and NBFIs are shaping it.
Signs of growth in domestic market. The Philippine financial system has shown strong growth in three major areas: banking, insurance, and securities. Banking sectors back in the Philippines have been growing fast. Since 2016, their total assets have been increasing by double digits every year. For example, by March 2018, total banking assets reached 15.3 trillion, up by 11.3% from the previous year. This shows that banks are expanding and more people and businesses are using financial services. Next is insurance sector. Insurance companies also grew steadily from 2008 to 2016. Their total assets more than doubled. After a small slowdown in 2013 because of Typhoon Yolanda, growth bounced back by 2016, with life insurance remaining the main driver of revenue. Securities market. The bond market, mostly government bonds, grew by 7.1% by March 2018. The stock market also expanded with 12 new companies listed in the Philippine Stock Exchange, reaching a total of 268 companies and 17.31 trillion pesos in market capitalization, meaning more investment opportunities and a stronger financial markets. Next is regulatory landscape. The government and financial regulators are updating policies to align with international standards, strengthening market operations and ensure stability. A. Alignment with global standards. Bangko Sentral ng Pilipinas issued new circulars to make it easier for banks to issue bonds, manage liquidity, and comply with Basel III international banking standards. Insurance commissions adopting international financial reporting standards and requiring insurance firms to set aside funds to protect policyholders in case of financial troubles. Securities and Exchange Commission update laws like the Security Regulation Code and Corporation Code to align with global practices. It is also studying how to regulate cryptocurrencies and online scams, working with agencies like the PNP and NBI. Philippine Deposit Insurance Corporation or PDIC signed agreements with other countries' deposit insurers to share information and strengthen global cooperation. Next is B. Deepening capital markets. New financial products were introduced to widen investment choices, such as dollar securities, exchange trade funds, green bonds for environmental projects, personal equity and retirement account, real estate investment trust, and other. The SEC, BSP, and Bureau of Treasury also launched a roadmap to strengthen the bond market, improve liquidity, and build a more integrated financial structure. C. Strengthening surveillance. BSP now reports to the Bank for International Settlements to track cross-border financial exposures. IC is developing a data system for monitoring insurance companies. SEC is creating a special unit for anti-money laundering and counterterrorism financing to ensure compliance and transparency in financial transactions. Next is the financial stability assessment. Financial stability means having a healthy, well-functioning financial system that meets people's needs and avoid large-scale problems. The Bangko Sentral emphasizes prevention. It monitors risk before they cause trouble. However, with changing global markets and rising debts, there are new challenges. For instance, rising interest rates and weaker peso, so they make it harder to pay off debt. Fintech, or the financial technology, is growing, offering easier digital transactions, but regulators must be careful about possible risk. ASEAN financial integrations can boost growth by pooling savings across member countries, but it also increases contagion risk, where financial problems in one country can spread to others. So next is the current risk in the Philippine financial system. So there are three major financial risks called the 3Rs. A. Repricing, refinancing, and repayment risk. Repricing, interest rates are going up, which makes borrowing more expensive. Refinancing, businesses and individuals may struggle to renew or replace old debts. Next is the repayment. Paying off loans become harder as the peso weakens against the US dollar. These are affected by US monetary policies attracting global investment to the US, slow global trade, and higher debt level worldwide. The Philippines, being a small, open economy, vulnerable to international shifts. B. Development in the credit market. Philippine banks' loan portfolios continue to grow, mainly funded by peso deposits. Banks are also borrowing in foreign currencies to support local loans. Corporate debts has been rising. Companies listed in the PSE increased their debt-to-equity ratio from 45% in 2008 to 86% in 2018. Household borrowing is also increasing, especially for housing and car loans. And last is the continuous demand for credit. More people and businesses are borrowing, which is a good sign of economic activity and financial deepening. But with rising debt and interest rates, the main concern is whether borrowers can sustain repayments. So this is the core of the 3Rs risk. Thank you.